Welcome back, everyone. This is the Mortgage Sensei. I hope all has been well with you. Today, we're going to be going over the closing disclosure. What is it? Why is it important? And how to read through it. So first and foremost, let's talk about what is a closing disclosure. A closing disclosure is normally a 5-page form. It provides the final details about your mortgage loan that you have selected. It includes the loan terms, projected monthly payments, how much you will pay in fees and other costs when you get your mortgage. So it's just going to itemize everything, showing what's paid at closing, what was paid outside of closing. That way you have a full understanding of what's going on. Now, why is this important? You really want to review this closing disclosure for accuracies, right? You normally receive it 3 days before closing to give you a chance to make sure you get everything corrected, all the figures are right, ask any questions that you need to ask, make any edits that we need to ask. But once the closing disclosure comes out, we really want to make sure that the loan terms are set, like the interest rate, the term, the loan amount. We'll receive third-party invoices from the title company, from the insurance company. We'll receive information from credit. Just all the figures just brought together and balanced between the closer slash funder with the lender and the closing attorney or the title company settlement agent when it comes to the title company or the escrow company. So let's go ahead and take a look at a real life example of a closing disclosure. For the protection of this client and the lender, I have, of course, marked out their personal information, but everything else is going to be pretty set forth. So let's go ahead and get the annotate up, and let's just start going through this. So the first portion that you see here having to do with closing information is going to be your date in which the closing disclosure was issued to you, the closing date expected, and the disbursement date as expected. Now with this one, this is a revised closing disclosure. That's why the date issue is the same as the closing date. But again, you will normally receive your closing disclosure, the initial one, 3 days prior to closing. Now under that, the settlement agent information here, this is the person that's going to handle making sure all the documentation is signed, make sure that the funds are properly dispersed out to a third party, and everybody gets paid and everything is ready to go to be recorded with the title. All taxes collected, so on and so forth. Under that, you have your file number. Again, this is your actual loan number with the title company. That's different from the loan number with the lender. So this is how they reference your file within their system when it comes to the settlement agent title company. Below that, you have the property, right? Now, the property is the subject property or the home in which the loan is going on to. Below there, dealing with the purchase, we have the sales price of the purchase. Now, under that, get this cleared up a little bit. There we go. All right, now moving over here to transaction information. Here, transaction information. As you can see here, we have the borrower. This would be you, the person that's buying the home. We have the seller, which is the person in which you're buying the home from, all of their contact information and address, of course, and then the representing lender that will be funding the loan. On the right side, when it comes to loan information, you have your loan term, the purpose, which in this case is the purchase, the product, which describes whether the rate is fixed in or adjusting at some point in time, the loan type, whether it's a conventional FHA, VA, or some other product like USDA or something else, the loan ID number with the lender, and then the MIC number, which is with the lender as well. Okay, let's scroll down just a tad bit to here. All right, now we're going to go over the loan terms. As you may notice, it's very similar, the first page at least, is very similar to the loan estimate. It's the second and third pages that starts to get a little bit different. So here you have your loan amount, right? Again, this is your total loan amount. In cases where, like this, the FHA, you have your purchase price minus the down payment plus the upfront mortgage insurance premium. Loans like conventional loans, you have your purchase price minus the down payment. There's no other upfronts that needs to be added to the loan. So of course, consult your loan originator to make sure that everything is accurate. Below that, we have the interest rate, okay? This is the interest rate that has been locked in according to what you qualify for, how you want your loan structured, your credit score, their term, and so on and so forth, right? So making sure that your interest rate, what that is upfront, normally on the loan estimate, what it is throughout the process, what your cost is for that rate, whether you're paying discount points or getting a lender credit for whatever interest rate that you select. You want to know what that is during the process. Always know, is my interest rate locked in or not, right? The loan originator should be communicating that with you, but in case that they don't, you as a consumer are now equipped to know, okay, is my interest rate locked or is it not? Moving on from there, we have principal and interest. As discussed in the loan estimate, has to do with your monthly payment. It only accounts for the principal balance being paid and the interest that's being paid per month for borrowing the money. That's all that's included in here. Now, as you can see here, can this amount increase after closing? Normally, you'll see all that as no, unless you're going with an adjustable rate mortgage or something along those lines, where it'll vary through the process, but that information will be clearly defined here as well as on your loan estimate. Now, on this section here, we have prepayment penalty and balloon payment. And then, of course, does this loan have that feature? So prepayment penalty, again, this is in a situation where the lender has stated, hey, if you pay this home off within a year, 2 years, 5 years, whatever the case may be, we're going to penalize you for that. Or a balloon payment is stating that, hey, you're going to be making this monthly payment, but in 5, 10 years, there's going to be a lump sum that's due. You can refinance, but you need to do something with this balance at the end of 5 or 10 years or whatever the agreement is. Let's clear that off. All right, let's scroll down here. Okay, so now we're with the projected payments. So this is where we're going to really break down, okay, how much am I paying per month for the mortgage in which I'm getting? Your payment calculation, going with a 30-year fixed mortgage is normally always going to show what it is, 1 to 30 years. Now, first you have the principal and interest. Of course, this is the same number that shows up top. Mortgage insurance, again, this is the insurance that is paid to the lender in case you default or go into foreclosure on the property. It helps the lender go through the foreclosure process and get the home back on the market to be sold. Again, lenders are here to lend money and collect interest. They're not here to buy and sell properties. After that, we have estimated escrow. Estimated escrow, as you can see, has to do with property taxes and homeowners insurance. It may be additional insurance, flood, hurricane, so on and so forth, but it's the money that you're paying per month that's going into your escrow account. All that combined comes to your total monthly payment. Now, this is technically what we call PITI, right? What is your total housing expense payment? Below that, we have the escrow broken down. As you can see, estimated taxes, insurance, and assessment. Now, we always say estimated because year over year, your property taxes may go up, may go down. Your homeowners insurance may go up, may go down. You may have a homeowners association dues that come into play or increase or decrease. So it's always estimated based off of that moment in time when you're closing. So, make sure you do your due diligence and make sure you are aware of what your property taxes is, what your homeowners insurance is going forward through home ownership. As you can see in this scenario, the same number applies here as far as the monthly payment. And as we can tell, only the taxes and insurance are included in the monthly payment. If there was anything other, of course, this box will be checked and it'll be outlined in this open space here, what it is that's included in that monthly payment. Moving down to cash to close. Again, cash to close is different from closing costs, okay? I know we want to lump that together, but in the lending environment, closing costs is different from cash to close because closing costs is your raw numbers and your cash to close is after credits and any other upfront costs that like your security deposit or your earnest money, any seller credit, realtor credit, anything like that, right? So cash to close is really what you're honing your eyes in on, but your closing costs on the next page is where we can really break it down, just like we did in the loan estimate. We can really break it down to make sure what is going on. All right, let's move on down. Okay, now we're moving into page 2 of the closing disclosure. Now, as you can see, compared to the loan estimate, this is a little bit different of a breakdown. It is very itemized because it has to be, right? We got to know where all monies are going to have came from, who needs to be paid, which side of the table is paying it, and so on and so forth. Now, before we start going down the loan cost section here, we want to first home in on the, let's get rid of that, on these gray boxes here. So you have your borrower paid, you have your seller paid, and then you have your paid by others, okay? Now, borrower paid, that's you, that you're the consumer. Now, there are costs that you pay at closing, like your cash to close, and then there's costs that you pay before closing, like your appraisal, right? Which is normally pretty standard there. Next, you have your seller pay. This is the person that you're buying your home from. Same thing, the cost that they pay at closing and the cost that they pay before closing, right? Now, your side is going to be more heavy than the seller, right? When you're acquiring a property, you're paying the closing costs, right? You're paying the costs to acquire the loan or acquire the home. The seller incurs costs too, but it may not be reflected here. The seller is the one who pays out the commissions through the realtor. So that 3% that your realtor is receiving, the 3% that their realtor is receiving, that comes out of the seller proceeds. So when you look at it, you say, hey, I'm paying all the costs here. The seller's not paying anything. That's not 100% true. It's just not going to be reflected when it comes to the closing costs, because the cost that the seller pay is not based off of you. It's based off of what they receive. So we'll see that a little bit more down to the bottom, but that'll be a quick explanation for you. Now, paid by others are normally what the lender pays. So you see the L here, that's the lender, right? That's us, okay? It could be the lender, it can be the realtor, it could be, any other party that's not the borrower or the seller. Now, going into box A. Box A here, again, this is your origination charges, AKA what the lender charges, right? What the lender is costing you to get this loan. As you can see in this scenario, in this one, it's not costing the borrower anything out of pocket at closing or before closing to acquire the loan. But we are receiving, as a broker, we're receiving compensation from the lender for the fee that we have. So in line number 2. Now, one of the things, I know some people are going to look at that and be like, gosh, Nelson, that's a lot of money that's getting paid to the broker. Well, you should see how much these big banks get paid. The big 3, you know who they are, or these large conglomerate or corporations. Legally, they're protected where they don't have to disclose to you how much they're receiving, right? That's legal, that's law. But as a broker, I am required to show to you how much we're compensated as a broker. So when you look at the compensation to a broker and then you look at the compensation to a lender, you won't see the same thing. It'll show 0, blank, not even disclosing it to you. Well, it'll be reflected in the interest rate, right? When you see a lot higher rate and more costs to get that rate compared to the rate that we get, just know that margin or that extra cost in the rate or the cost that you're paying, that's going 100% to the lender or the direct lender or the bank, right? And you don't know that's what's happening, right? It's just kind of the shifting around the numbers, and they're protected by federal law to do that. Because to be honest, if people actually knew how much these banks were making off of their loans, or these large direct lenders, what they were making off their loan, people wouldn't do business with them, right? Because there's just way too much money. That number will be double, maybe even triple, right? So always keep that in mind when you're working with a broker. We will disclose to you and show you how much we're getting paid. But if you compare that to the big guys, the big giant companies, there's no comparison. You're always better to go with a broker, because brokers are better. All right, now moving into section B here, right? Uh, Section B, again, these are services that you did not shop for, meaning that these are services that are needed on the loan program, and you cannot choose who these services are because it's a conflict of interest in most times. So here's what I mean, like the appraisal fee, right? You can't choose the appraisal company or the AMC or the appraiser because it's a conflict of interest. If the appraiser is your buddy, your friend, someone that you know you've done business with before, well, that person may or may not, but there's a chance that this person will be more favorable for you and not give an independent, third party, unmotivated, biased type of evaluation for your property. So that's why you will see that there, right? And there's different appraisal costs. The appraisal is based off of the loan program, right? And then the supply and demand of the appraisers versus the timing that's needed to receive the appraisal report. So what does all that mean? The appraiser is the one who dictates the cost. It's never the lender. It's just not, right? The appraisal management company and the appraiser sets the cost. So the lender may say, hey, it's like $500, $600. And then it may come back that the appraiser said, yeah, no, I'm not doing it for that amount. We need $800. We need $900 to do what you're asking us to do within a time frame because we're so slammed, right? And again, they're protected by federal law, so we don't get a choice. We just, we'll bring it back to you, be like, hey, this is what it costs to do the appraisal, and you just got to go about doing it. Next line, you have your credit report. Oh, I'll get that off. There you go. The next line here is your credit report. Again, we can't take a credit report that you provide to us. We have to order the credit report through a third-party service, right? Now, as you can see in this scenario, we covered it, right? But that's normally what happens. Number 3, final inspection for the lender. Oh, I kind of messed up. So line number 3 here, final inspection. So what this means is that the appraiser went out to the home and appraised the property, and there was something that wasn't right with the home that needed to be fixed or repaired or updated or completed, right? And then the appraiser had to go back out to the home to make sure that the work was completed. That's what's going on right here. As you can see, it's the same company, but that's basically what happens. And yes, that can happen, especially if the home is not ready to be final appraised. And that cost can be decided between whatever parties. You got your flood certification, right? What this is basically stating that the lender is checking to make sure whether your home is in a flood zone or not through FEMA, plain and simple. Under that, line number 5, you have your mortgage insurance premium here. There we go. Again, this is our amount that's paid at closing, but normally what happens with FHA loans, you see this FHA government loans, VA, if you're not claiming disability with the VA, USDA is another loan. You'll see this type of charge. But what happens is it says it's paid at closing. You're not paying it out of pocket, but it's paid at closing in aspect that it's just lumped onto your total loan amount. But it has to be itemized here. That way we know where all the numbers are going. And as you can see, it's down to the penny. We don't miss any numbers. And then after that, you have your tax service fee, right? This is just checking into your property taxes, right? Real estate taxes, as you can see here, right? That's what it's checking into in order to accumulate the numbers that's necessary with the closing disclosure. Now, moving down to the next section here, which is box C is what we call it. Box C. All right. Now, again, these are the services that you can shop for, which is normally the title company. You don't dictate who the title company is. Now, on your purchase contract, the seller and or the agents will choose the title company for you. But just know that you can change whatever title company you want, provided that all parties are in agreement. And then whatever the title company tells us that the charges are, that's what they are. We don't negotiate it. We don't set it. We don't do anything. The only thing that the lender has any capability of changing something is in box A. Everything else is third party, and it comes through this these documents here to let you know who's charging you what. Okay. All right, moving on down here. All right, going into other costs here. Going into other costs. So as you can see in box number E, all right, you have taxes and other government fees, okay? So this is like your recording fee, your county fee, your state fees, right? Depending on where you live. All of that will be accumulated here. This is what the title company or the closing attorney is paying out to the government, basically. Below that, you have your prepaid items, box number F. So again, your prepaid items is like your insurance. Again, in my previous video and loan estimate, we talked about the insurance has to be paid up front and whatever your proration in property taxes and prepaid interest. Those are your normal things that you got to pay upfront at closing, lump sum type. Box G, you have your initial payment at closing. So when you buy the house, you're paying your insurance up front, your property tax proration, and your prepaid interest. You're paying all that up front. And then you have an escrow account where you're making your monthly payments every single month going forward, and it's accumulating an amount of money so that when the property taxes and homeowners insurance are due in the future, it'll be paid through the escrow account, and the lender doesn't call you like, hey, taxes and insurance are due, fork out, $2,000, $4,000, whatever it is, right? It's already being built up for you. Now, this is really going to be based off of when the property taxes are due. But when it comes to homeowners insurance, normally 3 months, 2 to 3 months, but normally 3 months is accumulated at closing, and then property tax are accumulated according to when they are due. When they are due. Okay. All right, moving on down. Oh, and then line number 8 right here, aggregate adjustment. This is just the title company adjusting everything based off of proration when you acquire your property. All right, now box number H. Again, box number H normally and only have title or owner title insurance, right? Again, this is optional insurance. You're not obligated to get it, but what is happening is you're getting this insurance on your title in case once you take possession of your property, if there was a lien, encumbrances, a judgment that was on the property before you bought the property, this insurance will pay it out for you. If you don't get this insurance, you're taking on all previous debts and liens, encumbrances, and judgments on the property because you chose not to get an owner's title insurance. I always recommend getting it because the day you don't will be the day that you'll get a hefty lien that you have to pay. And it is what it is because you took on all debts, liens, and encumbrances of the property without proper insurance. All right. Now, when we get down to line number or box I, we have, as you can see, E, H, G, and E, F, G, H all added up. And then you have letter J, okay? Letter J will then take line number, box D and box I, add those together. Okay, so again, this is the cost due at closing. This is the cost paid before closing. And then lender credits. So this is any credit that you get off your interest rate or whatever the lender gives you will be credited to you at closing. And as you can see here, all the things that the lender paid for you on your behalf is off to the right, okay? Now, once we look at all of that, we'll scroll down to the next page. Now, this is calculating your cash at close. Now, this is the number, or this is the box that's really going to quickly help you understand what all is going on with the loan, okay? So as you can see, you have your total cost. There's J, box J, closing costs that was paid before closing under that, closing cost that was financed, okay? So you got your closing cost that was paid before closing here, closing costs, finance paid from your loan amount, down payment or funds due from you, the deposit, your funds for you that you're receiving, seller credits, anything the seller's giving to you, and adjustments or other credits. So that's any other credits that's coming to you that's not coming from the seller or coming from the lender. So maybe the realtor's giving you some credit of some kind. Now, the biggest thing is here. You have the figures that showed up on your initial loan estimate. Again, that was an estimate, but those numbers, we try to keep them as close as possible, but there are situations where if we retract box A, those numbers will fluctuate according to the interest rate. Box B, those numbers can fluctuate maybe about 10%. Same with box C, those numbers can be completely different if you're changing title companies. And then box E, like the escrows and the prepaids, those numbers are subject to change because it's based off of when you close, and we don't control those numbers, right? You can change insurance company, the premium may go up, the property taxes as we get closer to when they're due, that number may increase or decrease, right? So those numbers can change accordingly. But what occurs in this section here, when you're looking at final, right? This is really where you can quickly know what your costs are. So you have your total closing costs here, right? You have your closing costs paid before closing here. So like your appraisal report, that'll show up. This is zeroed out, of course. The down payment increase, right? So the down payment increase based off of the loan, right? The purchase price may be increased, or the amount of money that needed to put down. Maybe the interest rate had to go down. In this case, interest rate had to go down to make the loan work. So that means the discount points increase, or more specifically, the lender credit decrease. So the cash or the funds due from the borrower increase. The deposit stayed the same, right? Funds for the borrower zeros, no seller credit, and there was some slight adjustment that kicked in to help. And now you have your final cash to close, which is the same number that we saw on page number 1. Now off to the side here, it just kind of outline like, hey, did this change, right? Did this change? Did this change, right? And then it kind of tells you where to look on the closing disclosure, right? Which you can then compare to your initial loan estimate and see where the numbers were changing. Or you can simply look here and then just ask the question, hey, loan originator, hey, lender, I see that this changed, what happened, right? Because there's normally always a reason why something's changed, okay? It can be a legitimate reason, or it can be I don't want to say illegitimate, but it can be an error, right, that can occur. So for instance, let's say here's a legitimate reason. So you started with a loan that was a conventional loan, right? And for whatever reason, you had to switch it to an FHA loan. That's a legitimate reason. The numbers are going to change. Or you started with one title company, you changed title companies. That's a legitimate reason, right? An error will be in a situation where the loan originator didn't do their due diligence properly up front. And when I say properly do their due diligence, that is open to interpretation, right? Because the loan process, when you're going through underwriting, the underwriter is the one who's making sure everything is right. So you may be working with a loan originator who doesn't properly understand underwriting terms, and then go through the process, and then you're stuck left holding the bag, and the law protects the process, right? Not the individual, not the representative. It protects the process, because when you're going through the process, these disclosures come out to let you know, hey, this is what's going on with your loan. This is the adjustment that's occurring with the loan. Do you choose to move forward with this loan, right? And then you have to make a decision whether you want to continue to move forward or not. Now, it may be a situation where your earnest money is at risk, right? So that's why working with the right loan originator who's very knowledgeable in this process can help you out, especially when you get through the ebbs and flows of the process. Like in the situation right here, we had to make last minute adjustments because there was a situational change on the borrower side when it came to employment and income. So we had a reduction in income that we could use, and then I had to go in to make the loan work. This is post going through it. This person was working with a particular employer when we started the loan process, when we got the application, got the contract, we're going through processing and underwriting. And while we're going through all of that, this person decided to change employers, right? When we were like 2 weeks from closing. So then that new income documentation that came in, matter of fact, we had just got cleared to close. And when we did the verbal verification of employment, we found out she changed, this person, or she changed jobs. Well, when this person changed jobs, we was left holding the bag of trying to figure out how to get this to work. So that meant I had to lower the interest rate, which we see the reflection here. Now, of course, we closed, fine, this person's a homeowner and all well and done. But again, working with an experienced and knowledgeable loan originator helped in this situation in order to still get her into the home, but it also be able to explain to all parties involved, realtor, so on and so forth, especially on the seller side, explaining what exactly happened, and why this is an issue, and how we're going to go about fixing it to still get this deal done. And that's what happened, and we closed the deal. All right, now moving on down here, this is your summary. So let's stay on page number 2, right, where everything is itemized and breakdown. There's too many numbers, Nelson. Give me a summary. On page 3, this is where you're going to get the information you're looking for. So as you can see, in areas, and I'll just kind of do more of a highlight here. We have starting with K, right? Excuse me. Okay, so K, due from borrower at closing costs, right? That's your total itemized number. I know you look at that and be like, ooh, man, I don't got 338,000, so on and so forth. Right, but that's not taking into account that you're getting a loan, okay? So we have that. And then as you see, line number 1 is the cost of the purchase, so the purchase price, your closing costs coming from box J, the addendum down at the bottom, which we'll break down. There were some items that we had to pay off on this loan. We'll show you in a minute. And then you have your box L right here. We have your paid already by or on behalf of borrower at closing. We have that number. You scroll down, we got the deposit. We have the loan. So these are your credits kicking in, right? Deposit here. We have loan amount here, right? We have adjustments or credits that we show, that negative number on page 2. And then down at the bottom here, we have the final breakdown. The total due from the borrower, so that's everything that's due, not taking into account that you're getting a loan. Then we have all of the numbers that you're getting from the lender, credits, the loan in and of itself, and then your cash to close, right? This is the cash you got to bring to the closing costs, or bring to the closing table, right? And then as you see on the seller is pretty much 0 all the way down. But again, when it comes to the loan process, we don't really care about the seller side too much. You're our main focus. The seller receives their own disclosure that shows what everything is broken down. All right, now page number 4, okay? Page number 4 gives you just as you can see, additional information about the loan, right? Whether you can do an assumption, a demand feature, a late payment, negative amortization, right? You want to take the time and read through this, okay? Again, there's 3 documents you really should know: loan application, loan estimate, closing disclosure when it comes to buying a house. Now, like I said, the loan package is 80, sometimes 120 plus pages, right? But if I can break it all the way down into 3 page or 3 form documents that you should be looking at: loan application for accuracy, make sure your name is spelled right, your social date of birth is right, your employment information is written in correct, right? Your declarations and so on and so forth, right? Refer to the uniform loan application video where I went over all of that. The loan estimate, understanding what you're looking at, what you're reading, right? I know, not everybody's a numbers person or a legalese person, but this is home ownership here, right? This is the one time, or multiple times, but this is the one time in your life you really want to make sure you understand what's going on. because your one decision in that moment is going to make up your next, 10 to 30 years or longer of ownership of that home. So knowing what's going on is very important. On the right side, we have, of course, the account information, escrow account information, which, you'll see the kind of breakdown. It's all self-explanatory. Once you get through the first 3 pages and you get to this section, stuff start making sense, right? And if it doesn't, that's when you need to ask the question, right? All right, and then we'll get to page 5. Move this over a little bit. All right, so page 5, again, on a loan calculation, you got your total of payments, right? So when you're looking at this, total that you will have after you pay all payments for principal, interest, mortgage insurance, and loan costs as scheduled. So escrow is taken out of that. Principal, interest, mortgage insurance, and loan costs. They'll take all of that up, everything you pay at closing and what you're going to be paying throughout the life of the loan, bring it all together, right? 700 and 2,000. I know a lot of you said that, like, man, that's double the cost of the house. We understand that. You understand that, right? But just understand that the principal that you're paying down the loan. So that's your money just converted back into equity. So really, at the end of the day, the interest, the mortgage insurance, and the loan cost is the money that you're paying that you don't get back. Okay, always remember that. So we talk about the finance charge, right? The dollar amount the loan will cost you. The 381,000 number over the next 30 years is the money that you're paying out that you don't get back in equity. You might be able to write it off of taxes or something like that, but that's the true money that you're paying out over the next 30 years. Well, Nelson, that's too much money. I don't want to pay that. Well, you got one or two options. Either A, you pay the house in full, cash, pay for the house cash, or B, you continue to rent, right? Or C, you can get gifted a home or something like that from your family member or live with somebody, right? But you rent, right? And now if you're renting, you're paying somebody else's mortgage anyway. So they already signed these documents and agreed to all of this stuff. And you as a tenant or as a renter, you're paying their mortgage. So you're paying it anyway. And actually paying it more because you're not getting any principal back. Okay? The amount financed, or the loan amount available after paying your upfront finance charge. Okay? So that is the just the kind of the base loan amount is what we're talking about. So that's your purchase price minus the down payment. Now you have your annual percentage rate, your APR. Now this is the number. I've been doing this for 10 years as of this video, a little bit over that. And this is the one figure that most people don't understand what they're asking for or understand what's going on. What is APR? Let me kind of sum it up for you. An APR is just the interest rate. So you got your interest rate and all of the costs that it takes to acquire the loan based off of the lender and program broken down as an interest rate that's added to your total interest rate. That's really what's going on. So what does that mean? Things like your title costs aren't included, the appraisal's not included, your the taxes, the homeowner's insurance isn't included, but things like maybe the mortgage insurance that you pay per month, the upfront mortgage insurance premium, any origination charge, processing, underwriting that's paid through to the lender, discount points, all of that is inclusive with the APR and then reflected here. So the APR is one quick way for you to quickly see the difference between one lender to another, but you really got to make sure that whatever lender that's showing you their APR, are they actually showing it to you correctly, right? Are they showing it to you correctly? Because at the end of the day, some lenders can hide stuff and it'll never be reflected here, right? Or don't include stuff that another lender may include because of their interpretation of the law or the guideline. So that's what the APR is in a nutshell. But my biggest thing, I always tell people this, make sure you know what the interest rate you're paying, and make sure your cost structure baked down. You understand what they are and why they are, and make sure you know what your payment is and what's going on, or your loan terms. If you understand those three, APR is more like a fourth fiddle type of situation. But I know some people take APR as super and super serious, very serious, and that's okay, right? Just make sure you know what you're looking at and what you're reading when you get that APR. Below that, you have your total interest percentage, right? So as you can see here, the amount of interest that you will pay over the loan term as expressed as a percentage of your loan amount, right? So this is the total interest you pay divided by the the loan amount that you get, right? And it's normally always equal, just a little bit more than an equal or 100%. Now, on the right side, you have other disclosures. This is just kind of tell you, some other disclosures that's associated with your home buying process. When you're sitting at the closing table, you're going to have a whole bunch of documents that you're going to be going through. And the closing attorney or the settlement agent is going to be like this, and you're going to be signing, and you're just signing and signing and signing. You're excited because you're getting the home, right? Or you're someone like me that's going to sit there and read through each and every page, turn a 15-minute, situation maybe into a 2-hour situation. That's okay, right? Whatever you need to do that's comfortable or you think is right for you is all that matters. But again, if you're going to slow down on any page, you're slowing down on the loan application, the loan estimate, and the closing disclosures, because those are the areas where people get into a situation that they don't know what's going on. Oh, I thought the loan was going to be in both our names, and it was just in my name or just in her name, right? Or it name, or his name, whatever, right? Or oh, I thought I was bringing in this amount of money, and now I'm at the closing table, and all of a sudden I'm bringing in, this much money, right? Well, what happens in those situations, a lot of time, the consumer or you, the person, right, you're not slowing down and paying attention to the loan application, the loan estimate, and the closing disclosure. And what happens to the process, there's a lot of electronic signatures that goes out. So a document comes to you in your email, you pop it open, you're supposed to read through and review and make sure you know what's going on, but you just go click, 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 because life is happening. You might have kids, you got work, you got an event you need to get to, and you just need to get some sleep, right? You're hungry, you're tired, you're trying to watch a movie, you're trying to spend some time with your loved one, whatever the case may be, and you just click, 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 and not really paying attention to what's going on. So again, if you see anything that says loan application, loan estimate, closing disclosure, slow down in that moment, take a look at it, make sure, or if you do click through it, get back to it at a later date, or maybe open it up. Oh man, this is a loan estimate. Nelson told me I need to pay attention to that. I'm gonna come back to this when I'm in a place where I can really pay attention, and then just come back to it later and complete it. All right. Now, below that, you have contact information, right? Now, this is very important. This is where it's going to break down all the information you need for all parties involved, where it has to do with the lender, the mortgage broker, right? That's me. The real estate broker, that's the buyer. That's your agent that you're working with to buy your home. The real estate broker, that's the selling agent, the person who's helping the seller sell their home. And then the settlement agent, that's the title company, the closing attorney, right? That's the person that's going to be handling all the closing. Now, if you're ever in a situation, you be like, I don't know where I need to go, I don't know the number or whatever, refer to this page here, page number 5, contact information, and it'll have, as you can see, the address, the contact, the main contact person, the email, the telephone number, and pick up the phone. Or in most cases, you just call your loan originator. They should be, keyword should, they should be, experienced in the area to be able to assist you and help you. But again, like I say a lot in my videos and in my book that I wrote, be wise in who you work with, because not all loan originators are the same, right? They're not all experienced or take it serious enough to know all the intricate details of the loan process. I'll say it like that. All right. Now that's page 5. Last but not least, page 6. This is where your addendums are or anything like that. Like I said, in this scenario, because we lost income, I had to go about paying off some debt in order to get the debt to income ratio down in order for us to qualify for the loan. That's what's happening right here. Okay, we identified what we could do with the new information that was presented to us while we were already going through the home loan process, and then I was able to go in, make the adjustment, and turn this person into a homeowner and got the house that they actually wanted for them and their family. All right, so that covers everything when it comes to the closing disclosure. If you would, please, if you enjoyed the video, please like, share, comment, right? I love the comment section. Let me know what you want to see. Let me know what you want to talk about. Let me know what scenarios you're running into. Please also check the description. There's going to be jam-packed a lot of information. I will be coming back through and updating it as it goes. Be on the lookout for my book, How to Buy a Home with a Loan, is pending publishing. It'll be up through the Amazon. Join my Facebook group. Check out my Facebook page. Be on the lookout for my TikTok account that's going to be coming out soon. And just use me as a resource here, right? Like I told people before, a home loan is the same whether you're on the East Coast or you're on the West Coast, right? Whether you're up north or down south. A loan is a loan is a loan is a loan. They all work the same way because we're talking about federal laws. So, maybe you're in a state where, I personally can't help you out. It doesn't mean you can't get your information through me. And I help you get in contact with an experienced loan originator that can get you through the home loan process.